because I think anything that's based just on price alone, that edge is gone. It's going to be really difficult to find anything that's going to beat all the machine learning algorithms out there and all the guys that have rooms full of PhDs. Good luck trying to beat those guys. So I try to stick to things that are simple and repeatable. And
welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hello and welcome to another episode of the Better System Trader podcast. Andrew Swanscott here, and this is episode number 85. It's great to be here, and I'm glad you could join us for this one. Our guest for this episode is Gary Hart, the founder of TrendFinder Trading Systems, a company that offers mechanical, intraday, and swing trading strategies for the futures markets. Gary was a structural engineer with a master's degree who went on to become a member of the NFA and a registered CTA. Gary has been trading for close to 2 decades now and has had a number of his trading strategies take the top spots in the Futures Truth ranking. So we're going to discuss how he builds trading strategies that do that. But we also cover a lot of other aspects of trading today, including the challenges of developing day trading strategies and how to overcome them, the worst times to trade intraday strategies that can hurt performance, why price-based strategies have lost their edge, and how integrating additional data feeds can provide superior performance over purely price-based strategies, how to construct a portfolio of strategies and identify the strategies that complement each other, plus much more, including overfitting, optimization, swing trading, correlation, market behavior, index trading, volatility, and reusing trading ideas. Whew, we cover loads in this one, so let's get over to it. On to my chat with Gary Hart. Hi Gary, thanks for coming on the show today. It's really great to have you here.
Thank you, Andrew. It's great to be on the show.
Awesome. So how about we start first with a little bit of your background story, just so that we can get some context around what you were doing before you started trading and how you actually got started in trading. So do you want to just give us a little bit of your story first?
Sure. My formal education is in structural engineering. So I have a bachelor's and a master's degree in structural engineering. So that was my full-time career, everything, up until about 2008 or so. But I got started in trading in the 90s, and the whole reason I got into trading, and especially futures trading, is based on what the professors kind of drilled into us in architecture school. And that is just that the construction industry is very cyclical. The economy is very cyclical. Things are there's going to be good times and bad times. So be prepared for the bad times, because when there's no one building anything, the times get really, really slim. So I was starting to look at what would be something I could make money with during those bad times, and it had to be something that wasn't with the stock market, because the stock market moves the same as the economy does. It couldn't be real estate, because that's with construction, like everything, all your typical investment methods didn't work. And the whole reason I was looking at investment methods is I wanted something where I could really use compound interest, because being a math guy, I really wanted to use the magic of compound interest. So all my research I ended up coming across commodities trading. And, I got the flyer from some guy in a cowboy hat. I don't remember his name exactly, but, it was the thing where you can make 1,000% this year with commodities. And, it piqued my interest, and I started looking into it. And that's what got me into trading. And once I started reading books, and I don't even know how many books I read, I got into trading. And then in 2001, I got TradeStation, and I was able to then program and mechanically test my ideas. And that was really kind of all she wrote at that point. I was totally hooked at that point. So I've been, trading and testing ideas and researching and reading and living the markets ever since, and doing it on a full-time basis since about 2009.
Yeah. So do you think that engineering background has had some kind of positive impact on the trading styles that you're using today? Like were there some skills that crossed over into the trading arena?
Yeah, being logical, like being able to look at things in a very logical fashion. I didn't get too hung up on statistics or some other math. Whenever I have, the results haven't always necessarily been so great. So I found that the engineering background helps, but it can also blind you a little bit. So I think there is definitely an art to trading as well. It's not purely a mechanical thing.
Yep, I agree. And so now to your trading today, you mentioned futures there. Can you give us a bit of an idea on the markets that you look at and the trading styles and the timeframes that you trade across?
Sure. Well, these days, and really for about the last, I should say probably about the last 15 years, I focused almost exclusively on the stock index futures. When I started out, it was commodities, and as you know, the more investing I did or more research I did, the time frames got shorter and shorter to the point of day trading, and the stock indices really kind of fit that day trading. And then the reason I really stuck with it is there's two reasons I stuck with stock index futures. One is that there's so many ways to measure them. There's so many different things you can look at. Whereas, up and down volume, the breadth, there's all these kind of the VIX, there's all these other ways you can look at what's going on with the stock market. Whereas with commodities or, other things, you might have some macro factors or you may have some fundamentals, but you pretty much have price and volume to go on. And certainly the same thing with Forex. So that's one reason. And another reason is that, especially with futures, you can have limit moves, you can have very, very big losses. And although, with stock market, there are going to be the occasional really, really big moves, but they're much less likely, and at least historically, they've happened much less than other commodities. It's really, really rare for the S&P or to hit some kind of limit move, which it did after Brexit for a brief amount of time, and it did for a few minutes after the recent U.S. election. But for the most part, it has much less volatility than other commodities, so I feel more comfortable trading it.
Yeah, so I think there's a lot of appeal for traders especially traders when they're beginning to get into day trading. But I think as well that's a really challenging time frame. So what sort of challenges do you see when you're building strategies for intraday, and how do you kind of try and attack those challenges?
Yeah, well, one of the biggest challenges is that the markets don't have the kind of smooth intraday movement that they had 15 years ago. Day trading has, for the most part, continued to get more and more difficult as each year that goes by, and especially in the past few years because volatility has been so low as well. So when the markets don't move very much, it's hard to really make a profit because you got to have big enough winners to overcome the losers, obviously, but also you have to overcome the commission and slippage that goes with that. So if you're not getting enough price movement, it makes it really difficult to overcome the trading costs. So one thing is, for the most part, what has worked for me with day trading systems is to just not trade when there's not enough volatility. So all of the current intraday systems I use all have volatility filters built into them. So when the market's not moving much, especially like it's done the past few months, when it hasn't moved much intraday, I should say, the systems just don't trade. So a lot of my day trade systems, they trade fairly infrequently, or they'll go through periods where they trade almost every day, and then they'll go for 3 months with no trades. So it goes just to whatever's happening in the market.
Yeah. And so what kind of timeframes are you looking at when you're day trading?
Well, they vary by strategy. It can be from 1 minute to 5 minutes, or one I'm testing right now even uses 15-minute bars. But for the most part, they're looking to trade at most once a day. They're really trying to capture one big move for the day. So it would be I guess you would call it a very low frequency day trading type of strategy.
Yeah. So there can be quite a bit of difference in behavior between the 1 minute and the 15-minute chart, though. So how do you kind of adjust for those differences?
Well, the strategies aren't so much really time dependent. The only reason I use 1 minute in a strategy is to just get into the entries and exits earlier. The strategy could be run on a 15-minute bar. I just run it, they might run on a 1, 2, 3 minute bar just so that they don't have to wait until the bar closes. It's because nowadays, you can get a move in 15 minutes and then that's the end of the move.
Yeah.
So, if you wait too long, you miss it. So I've found that having systems that are dependent on the price the time of the bar, don't necessarily work very well. If they're kind of moving average based or kind of some kind of cycle based or whatever, especially intraday, they don't really tend to work very well. So I tend to look for systems that are more based on what's other filters. Looking on longer time frame, like are we kind of has the market been consolidating are the ranges getting smaller and smaller so that we're now more likely to have a breakout, that kind of stuff. And I found that the actual entry method, the actual entry technique isn't the most critical thing in the toolbox. It's more of determining when the best time and which direction to take a trade.
Yeah. You've just kind of given us a few, an indication of some of the things you look at, but where do you find these ideas for trading strategies?
I read and research probably too much. I love the markets. I know I've probably listened to every single one of your podcasts. I listen to others as well. I'm constantly reading and watching the market. So there's blogs, there's books, there's listening to podcasts like this, and then my own ideas just by looking at the market and saying, why did the S&P do that? So I have several monitors up here, and one of them has always got 15-minute charts of 3 different stock indices and crude and bonds and oil, and I'm just watching the market at all times so that I can say, okay, why did this move that way? And then, it's because oil did this. Okay, can I create a system around that, and does that hold up? And I'll find something that works. Yeah, it worked really well for the last 3 months, but when you go back before that, it didn't. So I did see something in the market, but it's not necessarily something that held up over time. So, there's just all those different ways I'm always coming up with ideas, and never enough time to test them all.
No, that's right. The list keeps expanding, I'm sure.
Oh, yeah, it's kind of crazy, yeah. But the list gets longer and longer, and then you finally just file the list away, and then you start a new one, and then it grows and grows and grows. And I have stacks and stacks of paper.
And you end up with a list of lists?
Yeah. And then I tried to do it all, save everything in the spreadsheet, and that got too long too. So the ones that are really critical, I email myself and I try to control that, and that's a no. I'll just never test everything. So that's just the way it's going to be.
Yeah, it's a good problem to have, I guess. Lots of ideas.
Yeah.
So
better than not having ideas.
Absolutely, yeah. Now you mentioned the changes in volatility over time. What other changes have you seen in the markets over time, and how have they kind of impacted or fed into the way that you build strategies and how your strategies perform?
I started out on trading commodities on I guess you'd call it a daily time frame, using daily bars. And as I got more interested, I know I read a lot of Larry Williams stuff and programmed all that in TradeStation, and he would use 60-minute bars, and my time frame got shorter and shorter. And through all the day trading I did in the say 2002 to 2007 or 8 or something like that, I actually all the way to about 2010, you could do trend following intraday or breakout systems. Those kind of things worked. It worked well. But what happened was, when pretty much about the time, I don't know if this is the cause, but it certainly appears to be one of them, when quantitative easing started. Initially it didn't drop volatility, but by about 2011, it really started dropping. In 2012, it became really, really difficult for day trading. The markets just weren't moving, and so I guess about 2010, I started thinking, okay, I saw the writing on the wall. It's like, okay, day trading is going to get more and more difficult. What else can I do? And I started testing swing trading ideas. Swing trading, meaning trades that are, anywhere from like 1 to say a month on average. My swing trading systems average about a week or so. Sometimes they only last 1 day. Sometimes, it could even be 2 weeks. But so I thought I need to adapt to what's going on. So I started testing swing trading strategies and released my first one in 2011, which was mean swing, and it's still doing exceptionally well. And then I also looked at other ways of doing swing trading strategies, and that's when I came up with FedSwing in early 2012, where I'm also incorporating, I guess you'd call it fundamental data, for lack of a better word, but basically following what what's happening in the real world, not just looking at price and volume, but inputting what the government's doing as well, so that you can input that. So I've had to adapt over time, and the swing trading strategies still seem to be a really good swing spot for a sweet spot for the stock indexes, because they still have a mean reversion type of tendency to them. They're going to bounce back and forth, and as long as people keep getting fearful and greedy, that the market's going to bounce up and down a little bit, and hopefully that swing trading type of method will continue to work.
Yeah. So you just mentioned there that you look at fundamental data. So you mentioned, I assume you're talking maybe perhaps about the Fed actions in the market.
Yeah.
What other kind of things do you think are worth looking at as far as external data that can help trading strategies like that?
I don't know about how much external data. There's probably some more out there. It's more difficult using that, because you end up having to input the data by hand, but because I use TradeStation, but for my latest swing system, Sentiment Swing, what I did with this one is it hardly uses price data at all. And what it does use is it looks at all the different breadth measures, meaning the number of advancers versus decliners, the up volume, the put call ratio, what's the VIX doing? Is it getting larger or smaller? What is it compared to 3 months ago, or this range? I think that's probably the best place to look for new ideas or profitable trading strategies, because I think anything that's based just on price alone, that edge is gone. It's going to be really difficult to find anything that's going to beat all the machine learning algorithms out there, and all the people that are the guys that have rooms full of PhDs, good luck trying to beat those guys. So I try to stick to things that are simple and repeatable, and I think looking at what's going on, in many different, I guess, like I said, the put call ratio, the VIX, like that stuff. I think all that is a good place to look.
So for traders who wanted to get started building intraday trading strategies, what would you recommend they do?
Well, first I would say don't. I want to, give you my real honest reaction is it's why do the hardest thing that's out there? But no, but if you really do want to take it on, because there are definitely benefits to day trading, and it's why I focused on it for so many years. It's you don't have your overnight risks. You get to have many trades. So you have so many trades that you can then have a lot more valid statistics of your trading system to see if it's valid. So there is certainly validity to day trading. I guess one area it would be to kind of go back to what I was saying before, looking at things like putting all these things together, like all the VIX, the advanced decliners, that kind of stuff. Look at combining things. Don't just look at price, and probably don't look at just price and volume. And not to say that those aren't valid ways. I mean, there's a lot of discretionary traders, I'm sure, that do phenomenally well day trading, looking at nothing but price and volume. But for people that have put them into systems, and it's going to be that any edge in that has probably been discovered already. Mm-hmm. So you have to look somewhere that's not fully developed yet. And I would say looking at different breadth measures, looking at different intermarket correlation, like, when crude does this and oil does that and gold does this, then how does it work? And it's not easy. It's not easy. There's a lot of different things to look at, and you have to be really careful about combining all these things without overfitting. So you want to keep your system simple, as simple as possible, and I'll obviously read a bunch of books and blogs and listen to podcasts. I don't know how valuable books are nowadays compared to the past. Nowadays, there's so much information on the internet and great interview, podcasts and blogs, and those are great places to look nowadays.
Yeah. Yeah. Okay, I just want to switch gears now and talk about futures truth. So you've had some strategies in futures truth that have ranked really highly. I'm not sure. I haven't checked lately, so I'm not sure where they are now. But I know in the past you've had like even maybe the top 3 or 4 spots there have all been your strategies, which is pretty amazing results. So what do you think the key is to achieving those kind of results? Like what was it that you did differently that you think maybe produced those results there?
One thing is, I kind of said before, keeping things very simple, and basically one of the systems that's always been on there is mean swing, and it's very straightforward. But I think part of why it works is it combines 20 different things all together. So it looks like at about 20 different mean reversion type of entry signals and exit signals, and putting those in a composite program seems to have worked really well. I mean, the out of separ results, the live trading results have matched what the in separ has, and it's just really rare to see that. But I think and I did virtually no optimization. I don't think I did any optimization. The only optimization I did, I think, was how many of those 20 signals should I use? I mean, how many of them, what's the entry trigger? Like, how many should I do? And even then, it wasn't like, I don't think I necessarily picked the best one. I just kind of picked the one that looked at the top of a peak. I'm like, okay, looking overall and looking at the number of trades, that looks like the good one. I mean, so it was developed without any optimization in it. That's actually true of several of the systems. I do very little optimization. The only optimization I do is more just to kind of validate that I didn't just happen to stumble upon a peak value for something.
Yeah.
So that's, really, the whole key to, I think, system trading is eliminating overfitting, or, I shouldn't say eliminate, minimizing it. That's your number one priority, is minimizing it. So far, I've avoided any kind of machine learning, data mining. I haven't used any kind of method like that yet, solely because it has such an overfitting bias to it inherently. Not to say that I'm not going to try it here in the future. At some point, I want to try everything, but I think that's why those systems have succeeded, is because they're based on fundamental edges in the market, and they were developed very, very carefully to avoid overfitting.
That approach you're talking about there, where you've got a bunch of different, I guess you could say, conditions, and then you're combining them. Do you use that same approach for your exits as well, or is that purely just for an entry?
For that system, it was both. So when there's a certain number of them all, indicating a long trade, then it goes long, and when there's no longer that many that are long or indicating a long, then it exits. So it doesn't hold trades very long. It's really just a quick in and out type of strategy. But I've as time goes by, especially with the stock market has a very different behavior to it for long trades versus short trades. So I will use different parameters for longs versus shorts. For the most part, my exit is just an opposite signal, or that, just the lack of the entry signal being there anymore.
Okay, and so you've mentioned a couple of principles that you use when developing strategies to try and reduce the overfitting, but is there any other things that you do, like some kind of validation steps or any checking that you do throughout the process to help reduce the chance of overfitting?
Yeah. For instance, on MainSwing, what I did, I developed it on just using the S&P index data because I knew I was going to be trading futures. So I didn't want to test on the stock index futures for my initial testing. So I did all my initial testing just on the S&P index, which is going to be highly correlated, but on the index. And I don't remember what time frame I used, but normally I'll save at least the last 3 or 4 years for completely out of sample. So definitely the ideal situation is to test on a similar market, but not the market I'm actually going to be trading. And definitely, and not do it on the current time period. Like right now, my favorite is to go to 12/31/2012. So that way I have about 5 years, or 4 years, I guess, of completely out of sample when I'm done creating the trading strategy. And unfortunately, that kills almost every strategy I try. So I go through all the tests, but that's unfortunate. That's part of the game. You got to test 100,000 of them or whatever it takes until you get that one.
Yeah.
At least that's my approach. I know other people. There's other approaches. You could have 150 systems and then you track which one's doing well and you trade that one. But my approach is much more simple, and I'm looking for strategies that are going to last forever, ideally. So that's I really focus on just controlling that out of sample data, and you only get to test that system once on that out of sample data. So it's your heart's racing. Is like you're done. You've done everything possible, and you get there, and and then you test it, and the equity curve's flat, or it's down, or it's just not very good. It's like, crap, here we go again. But to summarize, similar markets on a different time, earlier time frame, and then another method that I'll use depending on the system is also walk forward optimization. Do walk forward testing. Now the final system may not be. I may not do that. Some systems use walk forward optimization going forward, some don't. But I found it to be very valuable during testing, because it's like if you come up with an idea, or if a system's valid, I think it should be able to walk forward and be valid in that as well. Even in the final system you never change the parameters, it validates that the idea is correct.
So I'm glad you mentioned correlation there, because I wanted to ask you a little bit about portfolios, because I've seen on your website that you do quite a bit of portfolio construction with all the strategies that you've built. So I guess firstly, why don't we start with, why do you think it's so important to have portfolios of strategies?
Well, one is simple math. When you combine multiple systems, especially if they're uncorrelated or I mean, even if they have 90% correlation, when you combine them, you get to add up the profits, but the drawdown is not additive unless you have 100% correlated strategies that all have drawdowns at the same time. So when you combine strategies that have low correlation, you benefit from let's say you have 5 strategies that each make $100,000. So that's $500,000. And say the drawdown in each of them is, let's just say 20,000. Well, your final number then is 500,000 net profit, but you're not going to have $100,000 drawdown, because all those drawdowns aren't going to happen at the same time. So one, it's just simple math. The more strategies you can have, the better the math works. And then secondly, you never know when a strategy is going to not perform anymore, or when an edge is gone, or when when a strategy is going to go bust. So it also protects you by having more strategies. You're protected by when something goes wrong or starts having big losses.
Yeah. Okay, so how do you actually go about constructing these portfolios, though? Like, how do you figure out, or what are you looking at when you're trying to determine which combination of strategies are a good fit for each other?
When I first created swing trading strategies and looked on making a portfolio out of them, I figured this combining swing trading and day trading would be a good fit, because day trading does well when the market's really volatile, and then the swing trading it does well in all markets, but it's going to have its biggest losses during volatile markets, but it's going to do well in the less volatile period. So it seemed like a good fit. And then I started testing it, and sure enough, it worked really well. And I found a really good ratio, at least for my systems, was 1-to-1, having one swing system for each day trading system. But when I look at combining, and once I got to the point where I had many systems to choose from, there's no way I was going to combine all of them. I simply just looked at the correlation and, put the systems that had the least correlation together. And so when I built the portfolios that I show on the website, that was the idea. So, whatever systems have the lowest correlation, put those two together, and then the next, and then then just kind of build them up from there.
Mm. Now, another thing I noticed when I was looking on your website is that just looking through the strategy names, there seem to be, I can't remember any of the names off the top of my head, sorry, but there seem to be like a strategy name and then a 1, 2, 3, 4, and 5, which kind of implies or indicates maybe that the strategies are using very similar kind of logic. I don't know if that's correct. That's just an assumption I made, which could be completely wrong. But what's your take on reusing ideas in strategies but just making them slightly different? Like, how much variance between strategies do you need to have?
Well, definitely the more the better. And to answer your question about the systems on the website. First off, the portfolios have 1, 2, 3, 4, 5 names to them, but that just means addressing what the size of the portfolio is. So, like Index Trader 1 is 1 day trading, 1 swing system. Index Trader 5 is 5 swing, 5 day trading. So that's where the numbers on the portfolio come from. And then for the individual systems, there are like Mean Swing and Mean Swing 2, FedSwing, FedSwing 2. There are a couple systems that are like that. For Mean Swing, the only reason I have Mean Swing 2 is that I added a fixed dollar stop to it. And and this was just a few months after it had come out. And so since it was different, I had to, compliance wise, I just wanted to make sure everyone knew it was different. I mean, nothing changed in the strategy except that I said, max loss is 5,000. It's like that was it. And then FedSwing and FedSwing 2, it's a little different because FedSwing 2, I was trying to adapt to what the Fed was doing nowadays. So it's a more conservative version, trying to adapt to what the market, what the FOMC is doing. Unfortunately, the FOMC is doing really nothing for the stock market, so there's not much edge with that system currently. But basically, I think you can build on an idea. But you do have to be very careful. You can't just sit there and re-optimize it and hope for the best. It's probably not going to work. And you can't keep tweaking the system. Ideally, I never change the system. So like Mean Swing, FedSwing have never been changed, except for I think I made like a code correction because a stop didn't work right for a broker or something like that. But the strategy itself is unchanged. I think the way to go is you just keep creating these systems. I think if you keep trying to tweak an existing one, you're just going to keep overfitting it, and it's going to be really difficult to determine whether it's going to work in the future or not.
Yeah. Okay, great. Thanks, Gary. So I just want to ask one final question now before we start wrapping up for today.
Sure.
And this one is a quote from your blog. Now, I dug really deep into your blog to find this one. I think it was, I don't remember the date, but I think it was maybe about 5 or 6 years ago. So this could be a good test of your memory, but I think it's an interesting point that you make. So I really wanted to raise it with you today. Let me just read it to you. Okay. Hopefully you remember it. Trading system and investment success only happens when one develops the ability to base decisions on the probable future instead of the certain past. I think that's a really interesting statement. What do you mean by that? Well, firstly, do you remember saying that?
So yeah, I mean, I don't remember it off the top of my head. I remember a blog post, or I remember one time saying that only basing your decisions on past data is like driving down the road looking in the rearview mirror. And that's kind of the way and in trading systems, I mean, for the most part, that we have no choice, because we don't know the future, except for some certain situations where, like we know that FOMC is going to be buying whatever billion next week. Like, there are a few things where we kind of know something about the future. But for the most part, we kind of, we have to drive down the road looking in the rearview mirror. So to go back to the probable future, it goes with the kind of curve fitting, overfitting, whatever. We don't know what's going to happen in the future, and we never will. But we do know that it's not going to be what happened last week. We know that just because a trading system or whatever has had a losing period for the last 3 months or 6 months or a year, that doesn't mean that the next 3 months, 6 months, year, it's going to be a losing period. So I guess what I was probably getting at is, and this especially goes to drawdowns, because the most difficult thing with trading systems is withstanding drawdowns. Trading system creation has overfitting is probably the biggest problem there. So that's why I was saying you got to go on probabilities. And if the system was developed in a robust fashion, I mean, you never know 100%, but if the systems are built in a robust fashion, then you go stick with the probabilities. Don't just look at what happened for the last 3 months. Another thing, I don't know if this relates directly, but it just popped in my head. Like going into the presidential election last year, everyone knew that if Trump was elected, all hell was going to break loose, and the market was going to go down 20%, and there's all kinds of predictions. And a lot of this was on past. Maybe past is the right word, but these predictions were not been made looking at a probable future. They were based more on emotion or thinking of things that have happened currently or in the past. So I think one of the keys to trading is to look and trade based on probabilities, not on necessarily what you think or feel. In fact, I have something that I have on my wall right next to my computer, and I don't remember when I put this up, but it's something that I always keep in mind. I have an equity curve of my, I have a CTA program as well. So and making sure I manage it correctly, I have a performance summary, an equity curve up there, and in big block letters, I write trade per the systems, not per my beliefs. Yeah. So it kind of goes back with what that other quote was, and you got to stick to the probabilities no matter what you think is going to happen in the market tomorrow.
Yeah, and it was probably a bit rough of me to pull out a quote from 10 years ago, so apologies for that. Right. But there was an additional part to that towards the end of that blog post where we'd just gone through a period low volatility, and you were suggesting that I think perhaps you're looking at the 3-month VIX or something. I don't recall exactly, but there was some suggestion that volatility would pick up, and you said if you've got these intraday strategies which kind of thrive on volatility, this could be a time when you might want to start trading those kind of things, because the probable future suggests that you might be coming into a market condition which is ideal for these particular types of strategies. So I thought that was really that was a really interesting take, and is something interesting to consider. I think that's a pretty cool point.
Yeah, I think that's kind of the next level of being a good trader is going. Well, one is following the systems, or what especially if you're a system trader, right? Is following systems, and then also making your like maybe let's say you have 20 systems and you can't trade them all at one time. You just don't have an account size for that. The next step would be knowing what systems are probably going to do well going forward. And that's where I guess you would call it discretion steps in. But, if you just pick the systems that have been doing the best for the past 3 months, that may not be what works best for the next 3 months. You got to know what the systems are based on, what the characteristics are, and go in that fashion. That's, level 2, I guess, trading, if for lack of a better way to describe it. Yep.
Awesome. All right. Well, thank you very much, Gary. I just want to start wrapping up now. I've got a couple of quick closing questions for you here. The first one is, what's the biggest lesson that you've learned through trading?
I think I pretty much hit on that earlier. And, trading per the systems, not per my beliefs. And I guess what kind of goes hand in hand with that, or how I learned that, is that I am not a very good discretionary trader. You might say I'm a horrible discretionary trader. And when I sit there and try to do discretionary trading, or I watch the price action, I think I know what's going to happen. I fall right into the same trap as all the other people that are falling into that trap. So that's where some of the edge comes from with the mechanical trading systems, and being able to test. So like, if I'm watching the market and I say, God, it so looks like the market's going to rip up going into the close. Well, now, instead of saying, you know what, that's what's going to happen, let me go buy, because it's so easy to buy. It's so easy to trade, right? So it's like, okay, you know what, I'm going to buy one contract. Oh, it went down a point. Oh, now it's coming back. Okay, let me add another contract. That's the, I think virtually, based on your laughter, I think you can relate, and virtually everyone listening to this can probably relate to that.
Yeah.
So, my lesson now is like, okay, when I see that happening, it's like, okay, let's look at everything. What's some way I can quantify what I see, and then I can test what I see, and then see if it's valid or not. And 99% of the time, it's not valid. Well, I mean, maybe a little high, but it for the most part, what you see isn't necessarily what's going to happen consistently.
Yeah. What is the best trading advice you've ever received?
To have reasonable expectations. So when I decided to make trading my full-time business and close down engineering back in 2008, I did some workshops, and from a guy that was a successful system trader, and he was great at telling us he's great. He's very straightforward and honest, and said what percentage returns he had been making for this person that he worked for. And I think they said and what can you expect currently? And I think he said, if you're a really, really good system trader and you follow all this and do everything well, you could probably make about 25% a year. And you could just hear there were crickets chirping in the room after he said that, because at that point we're all like, hey, I mean, annual returns, shoot. I mean, I'm going to double my account in the next 3 weeks. I'm just trying to make money every day, annual, God, whatever. And so that kind of humbled me, or said, okay, let me slow down a little bit here and really take risk control seriously. Let me look, if I'm going to be trading other people's money or offering my systems for other people, I really need to be a lot more diligent and risk focused, and have reasonable expectations. So I think that was probably one of the biggest or best pieces of advice I got.
Yeah. So I guess you didn't go to the seminar with that guy in the cowboy hat who makes 1,000%, right?
No, but I sometimes I got to go back and quantify his method again, because I think it had validity. But it's and I did. I did double my account. That's part of what hooked me. When I paper traded his method for a while, and I literally doubled my account the first 2 months I traded with live money, and that was it. And then over the next 6 months, I lost it. I lost all the profits. I got back to where I started over the next 6 months, and I said, maybe I don't know it all yet. So that was the road that began the road of reading books and testing and researching and really truly learning and being a student of the markets.
Okay, next question. What's your favorite trading book?
Well, I think, like just about everyone else, Reminiscence of a Stock Operator is probably my favorite. I don't know how many. I probably read it 5 times at least. I'm not sure. And I read it again a few months ago. And it's just because it captures the trading game so well. You're not going to learn any trading method out of it. You're not going to learn, position sizing. You're not going to learn anything that's practical. But it's just a very entertaining and enriching book for learning the psychology or what goes on with trading and the mindset of a trader. But then for more practical books, I think one of the best for mechanical traders would be Evidence-Based Technical Analysis by Aronson. That's an excellent book. And there's probably some books now that are even better than that, but I've kind of gotten to where I just don't really read the trading books anymore. So I'm a little out of date with anything that's been released recently, but I think the Evidence-Based Technical Analysis is definitely an excellent book.
Okay, and what is the best way for listeners to get in touch with you?
On my website, I have a contact page, but basically my email address, which is gary@trendfindertrading.com. You can also feel free to email or call or Skype me as well. I'm pretty much here every single day during stock market hours, plus or minus a couple hours before and after.
Awesome. All right, I'll have a link up to your website on the show notes page so people can find that easily. All right, well, just before we go now, is there anything else that you'd like to mention before we wrap it up?
No, I can't think of anything right off the top of my head. Just keep in mind that trading's not easy.
Yeah.
It's just, or I should say successful or profitable trading is not easy. And if it were, I probably wouldn't even be doing it. That takes all the fun out of it. If it's not challenging, for me, it's not any fun. So,
yeah.
I think I'm always going to be challenged. So hopefully trading's always fun.
Yeah, absolutely. All right. Well, thank you very much for your time today, Gary. It was really great to have a chat to you. So I wish you all the best and catch you soon.
Thank you so much, Andrew.
Thanks, Gary. Cheers, mate. A huge thanks to Gary for chatting with us today. It was really great to hear his take on a number of aspects of trading. One of the statements that really made me, or that really caught my attention, was when he mentioned that he thinks the edge is gone for strategies that are purely based on price alone, and he likes to include other data like he mentioned the VIX, put-call ratio, advanced decline, market breadth, maybe up-down volume tick. There are a number of options there, but we've covered this a few times in the podcast before. Actually, we even had a podcast episode dedicated to market internals. I think that was episode 51 or 52. I've done a lot of testing of this myself, actually, and I've also found that including some of those other measures into a trading strategy, especially in index trading strategies, that can have a really big impact on improving the performance of a trading strategy. So if you want to look into that further, I do recommend having a listen to the Market Internals episode of the podcast. And if you want even more info, you can head on over to tradingmarketinternals.com, where you can download videos, case studies, and even some code, I think. So that website was tradingmarketinternals.com, or I'll include a link to that on the show notes page as well, so you can find it there at bettersystemtrader.com/85. Anyway, that's it for another session of the Better System Trader podcast. We hope you found some value in this one, and we'll have something more for you next week, so catch you then.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.